Welcome traders, investors, would-be traders to this presentation of PairTrade Finder Pro's Fast 50 US equities pairs and the introduction of our March 2021 vintage. So, who are we? We are PairTrade Finder. If you don't know us yet, we've created a software platform called PairTrade Finder Pro. It is the world's leading online pair trading software platform, and it can trade global equities, ETFs, CFDs, futures, and FX. We created this over 12 years ago, and it has been used by tens of thousands of successful pair traders, both professional and retail. And it's designed to allow any investor or trader to learn to make winning long-short trades or pair trades consistently with controlled and measured risk. And the software offers you a suite of professional advantages to help you level the playing field with institutional traders. So you can see it over there on the right. Bull market, bear market, sideways market, with pair trading, it doesn't matter. Now, why is that? Well, why do you want to pair trade stocks? The main benefit of stock pair trading is that your exposure to market and sector risk is significantly reduced. So it can protect you from a market crash or a big account drawdown on the basis of a market crash. So it's hedged. And that's done by holding both long and short positions in equal dollar amounts in a highly co-integrated pair of stocks in the same sector and in multiple co-integrated stock pairs across sectors. So you create a portfolio of pairs of highly co-integrated stocks. Now, why does it work? Well, the second point here is key, which is pair trading works because the price ratio relationship between two co-integrated stocks is much more predictable and reliable than the outright prediction of the direction of the price of any particular stock. So a typical example, Coke and Pepsi, don't know if they're co-integrated right now, but let's say they were. It's much easier to determine what the ratio of the price between Coke and Pepsi is going to be in any given moment than what the price of Coke or the price of Pepsi is going to be in any given moment. And that's why people pair trade. Okay, so what does the latest research say, and why do you want to pair trade stocks? Well, a latest study done by Huck and Afawubo on co-integration pair trading. You can see this on our YouTube site. We have a full analysis of their study and how it applies to our top pairs. Anyway, they say the robust strategies are the following. Co-integration. Returns are especially high with monthly excess returns. This is monthly, guys. Including transaction costs greater than 1.38% and going up to about 5% per month over a period of more than 10 years. And that's just based on a 2.0 entry stretch, 0.0 exit stretch. So it's a very rough set of parameters to review pair trading returns. And what they're seeing is there's definitely positive returns there, alpha generation that can't be explained by any kind of market moves. So, PairTrade Finder's Fast 50. What's it all about? Well, what do? We get a curated set of 50 stock pairs, and the latest vintage has got 99 tickers. And these are generated after we spend hundreds of hours of backtesting, filtering, and screening over 1,800 USA companies. We do all the hard work for you. And so what happens with this Fast 50 set of US stock pairs? Well, they're preloaded into your PairTrade Finder Pro when you subscribe. And the latest vintage, we're talking about the March vintage, it was completed on March 18th. So it's been out of sample now for about 12 days, 13 days. Produced in-sample backtest trading signals over the 12-month period of 177 closed trades. So that means it's kicking off about 15 trades per month. So if you're trading just this, you'd be doing about 15 entries, 15 exits per month, or 30 trades in total. 98% win rate in the backtest. Average winning trade, and we base all of these numbers on $5,000 a leg trade size, is $420. So you would need for a $5,000 a leg trade, pair trade, you would need 5,000 plus 5,000. That's 10,000 total exposure. If you're using Interactive Brokers CFD margin 5 to 1 for a novice CFD trader, that would be 2,000 of margin required. Average losing trade, only $78. Average reward risk, 5.4 times. And that group of 50 stock pairs over the 12 months produced a total net profit of over $72,000 or 179% return on the margin in those 12 months. That equates to about 8.9% per month. Okay, and let's contrast this with the up to 5% per month that co-integration based pair trading was shown to have produced in research looking back over a 10-year period. So What's new for this Fast 50 vintage, and why do we call it fast? Well, what are we doing when we're creating the top 30, the Fast 50? What we're trying to do for you, for new pair traders, it's our attempt to optimize the reward risk from pair trading industry sector screened US stocks. And so we balance finding the highest probability opportunities with positive reward risk against generating the largest possible opportunity set of trading signals to increase potential earnings. So the more signals we have, if they are well screened and have high probability opportunities, the more money we can make in a given amount of time. So the shorter we make the look back period, 21 days, 63 days, 126 days, the shorter it goes, the more trades you get. But there's a degradation in the reward risk, and you don't want to be spending all your time trading to be making less money and giving your broker more money. So what do? We've looked at a lot of research out there to try and find the sweet spot for reward risk. And here's just a quick table pulled out of a Saxo Bank report, which was called Has Equities Pair Trading Had Its Day? That was at the end of September 2015. And so what they did was they took all S&P 500 US stocks, they grouped them by industry subsector, they used a 2 entry stretch and a 0 exit stretch, and all they did as a screen was take anything that was correlated, price correlated over 80%. They found 1,395 pairs. They traded them based on 2 entry, 0 exit, no stop loss, no time stop, and they did it for 12 and a half years, okay, from 1st January 2003 to 30th September 2015. So that was their research, their backtest. What did they find? Well, if you use a 13-day look back, a 21-day, a 63-day, 126, and 252, you can see what happens here. These are the number of trades. If you're at 21 days, you had over 60,000 trades. If you were at 63 days, that was cut in half, more than half. And if you're at 126 days, that was cut in half again. So you see, you're trading so much fewer times when you have a longer look back. But as you can see here, the mean return and the Sharpe ratio, which is reward risk, which is what we like to look at, it was at its peak in the shorter and then starts to degrade as you go longer. And the actual profitability was at its peak at 63 days, okay, and became unprofitable when you went too far off, okay, because you get these, they don't have a time stop, so they got these big losses because they just let a pair that, for whatever reason, started diverging and wasn't going to reconverge because there'd been a fundamental value shifting event, so they just let it run and run and run. So that's why you got these big losses. We would never do that in our trading strategy. Okay, that said, this is a research study. So what's interesting, though, is they found that the sweet spot of profitability is close to 63 days, but the sweet spot of Sharpe ratio reward risk was more closer to 21 days. So what have we done? We've set a 50-day look back for this Fast 50 vintage versus our previous 63-day or 100-day look backs for the old top 30. Hence, we call them fast because they're faster than the top 30. When we combine this 50-day look back with our rigorous co-integration screening, profitability screening, and fundamental screening software, a subset of high-octane pairs can be created. And that's what we've done. And that's welcome to the Fast 50 US equities pairs. So what do our customers say about PairTrade Finder and our curated stock pairs? So there's a recent testimonial, unsolicited, from Michael Weiss here. I used to manage a prop firm in the 80s. We had over 1,000 traders. We did a lot of pair work back then. You have an excellent program. I've been testing your top 50 pairs for about a month or so, and it is doing quite well. We've got Chris Stone over here. I am amazed that more people are not using your software. I've managed to make 8,000 in the last 3 weeks. I credit that to you, your staff, the great videos, and the excellent software. Let me say that I love your product, and I intend on being a lifelong user. I am truly grateful. It's really phenomenal to receive these kind of emails from people because it gives us motivation to keep doing what we're doing here. Here's another one I love. This is actually one of my favorite emails ever received at PairTrade Finder, which is just to say how delighted I am with your product. For the first time in 10 years, I am consistently profitable. If I can sort out my discipline and stick with the signals, the results would be even better. Yours eternally grateful. You know, that's what it's all about here. We're trying to teach traders to use a tried and tested, over 50-year-old hedge fund trading strategy to attain consistent profitability, and hopefully somewhere in line with those numbers that we saw at the beginning of this presentation. You can read the other ones here. I think what's really worth reading is this one from Geoffrey. I started trading the strategy in September on a Collective 2 account, also in my own IB account in October. I'm just glad the strategy performs as expected. Backtest equals real time. That's, very unusual, and maybe it's only over a few months, but the reality is, yeah, sometimes our real-time trading equals those backtesting results. Other times it doesn't. Okay, so trading, it's very unusual to get your out of sample or live trades be as good as your backtest, but we don't try and curve fit. We try and have robust parameters, and usually we're getting results in line with historic studies on pair trade finding profitability. So let's take a quick example of one of the new Fast 50 U.S. equities pairs, because pictures are worth 1,000 words. So this is First Hawaiian Inc. versus First Merchants Corporation. And over a 2-year look-back period, they did 10 trades. And the average price correlation of those two stocks was over 80% in that time period. The co-integration 0.99, which is a p-value of 0.01, highly co-integrated. And just allocating money to that pair and only trading when those trades came up and letting the capital sit doing nothing the rest of the time would have generated a compound annual growth rate of 21% a year without leverage and a max drawdown of only 4.5%. Okay, so almost 4 times reward risk. Pretty nice. The average net profit of a trade was $231 on a 5,000 a leg size, and 90% of the trades were winners, and the average trade lasted just over 10 days. Look at this equity curve on the bottom left of your screen here. Starts off, the one negative trade was here, and then ever since then, so what are we looking at? Since June of 2019, every single trade has been a winner. Boom, 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 boom. And that's the kind of equity curve we just love to see. Over here you have the blue line is the moving average of the price ratio with a 50-day look back, and the green line is the daily value of the price ratio around that moving average. And what we love about this is it's fairly flat, and you have lots and lots of zero crossings. That's the sign of a potentially attractive pair to trade. Zero crossing mean when the price crosses over the moving average of the price, so there's no trendiness. That's what we look for. What are these companies? Well, First Hawaiian operates as a bank holding company for First Hawaiian Bank, and they provide a range of banking services to consumer and commercial customers in the Hawaiian Islands mainly. They got 54 branches across the islands, also Guam and Saipan. They've been in business for a very long time. First Merchants is a financial holding company for First Merchants Bank, and they do the same thing, community banking services, and they do it in 124 banking locations in Indiana, Illinois, Ohio, and Michigan. So how do these look on a fundamental snapshot, which you can generate immediately on every pair in your watch list? Well, they're both in financial sector, banks, regional industry subsector. Their price ratio is not far off, so it's if you have 10 to 1 or something like that, it becomes a more difficult ratio to trade. This one is less than 2 to 1. That's good. Beta of the stocks 1.35 and 1.34, almost identical. Market cap 3.5 billion versus 2.4, very close. Price to sales valuation on these 6 and 5.4, and the most important measure of bank value is price to book value 1.28 versus 1.33, so almost identically valued by the market. And the dividend yield is 3.8 versus 2.2, so pretty close on dividends as well. And that's what we do when we do a fundamental screen. Those are the main things we look at. We want to see that they're in the same business, that they're in the same industry subsector, that they've got similar betas, the market caps aren't too far out of line, that the valuation multiples that the market's putting on the business are not too far off, and that they don't have a very divergent dividend yield. And that's the screening we do on every one of the Fast 50 pairs for you. Okay, so that's First Hawaiian. Here's an example of the pair charts. This was a trade that it took here. If you want to see how we analyze trades, this is how you can use the software to do that. You can see historically every trade that was taken on the 9th of November at the close, 3.41 standard deviations. You went short FHB, long FRME. That trade closed 1, 2, 3, 4, 5, 6, 7 trading days later. You lost a little bit of money on the short, but made lots of money on the long. And it exited at 0.62 standard deviations. You can see it here, the entry and the exit. That's the price ratio, and that's the moving average of the price ratio. You can use your RSI chart here to look for divergences. And of all the trades we show in this last year on this pair, this one looks the best for us because it had a very strong divergence between the rising price ratio, higher high, higher high, higher high, and lower high on the RSI. So that's a divergence. We like to look for those. We think it increases the probability that the price ratio is going to turn around. And then you have the plus minus chart, which is the number of standard deviations around the moving average of the ratio, and we enter when it's above 2.7 or below negative 2.7, and then we exit when it crosses negative 1.0 or plus 1.0. That's what the Fast 50 settings are. And then we also look at a percent for mean chart. You can look for resistances, support levels, and all of that. So that's what you can do with the pair charts to make sure you're getting the highest probability entries, and with a lot of backup analysis to make sure you feel comfortable that the trade has got a high probability of coming good. So how do we create these Fast 50? As we mentioned, each stock pair has to meet stringent historical return and co-integration hurdles and pass that basic fundamental screening we showed you here. Okay, so it has to be ticking all of our filters on the back testing first, and then we do the fundamental screen, and if it passes that, then it becomes a Fast 50 US equities pair. So what do we do? What's our sample selection? We take all NYSE Amex Nasdaq stocks that have more than a $2 billion market cap. Most of them are over $3 billion, and they have to have over $2 million a day of average daily traded volume, and they have to be easy to borrow. Then we do the fundamental screen we just talked about before. The backtest parameters in this set, it's a 2-year look back, 2-year period of backtest, 50-day look backs for all of standard deviation stretch and ratio look backs. We entered a plus or minus 2.7 entry stretch, exit a plus or minus 1 exit stretch. We put in 10 basis points of commission slippage per trade, 40 days max days in trade, and we're trading all of these. All the numbers you see in here are based on 5,000 a leg, and we don't apply an RSI filter on the entries. How do we filter the back tests? We look for any pair that's got 0.90 of co-integration or greater. We use the augmented Dickey-Fuller test for co-integration, and we use reverse co-integration, so we invert the ratio. So a p-value of 0.10 reads as 0.90 in PTF Pro. We let that be 0.88 or better as a tolerance for data, whatever. Perfection is not always possible in trading. So the average net profit per trade, we always look for greater than $150 based on 5,000 a leg, and usually greater than 200. We want a compound annual growth rate in excess of maximum drawdown. We want a target max historical drawdown of less than 20%. This is really important for us. So all these pairs, none of them had a historical drawdown of greater than 20%. If you're trading on 5,000 a leg size, that means a loss of $1,000 on any one trade. So we don't want anything that would come close to that level of loss. Now, minimum win rate at least 70%, target of greater than 80%, and we want the correlation to be over 50%, but the most important thing is the co-integration. It's got to be co-integrated, and then commissions and slippage, we want that to be less than 20% of gross profit. We're trading for ourselves, not for our broker, okay? Now, the summary of this back test, we'll just dive in a bit more detail. So this was done, this is the summary from 19th of March 2020 to 18th of March 2021 for this group of Fast 50 pairs. We've got 99 tickers. There's only one duplication. There are 34 industry subsectors, so you're very well diversified across industry subsectors. And you had 177 closed trade. You generated 72,343 of profit and 173 winners, only 4 losers, 90% win rate. Biggest winner, $1,451. Biggest loser, only 226. Average of 420 win. Average of negative 78 loss, and 5.4 times reward risk. The longest trade, interesting, was only 33 days, so we never hit our time stop. Shortest was only 2 days, and the average was 12 days, about the same as the previous Fast 50 January vintage. What did that mean? That kind of money? Well, in your account, if you're trading on 5-to-1 CFD, this is how we calculate what we call an imputed return analysis. There were a total of 170 trades, 177. If there is an average of 12 days in a trade, we estimate about 14 trades a month. We estimate that you need at least 2 trades headroom on that, so 16 trades, just in case there's a more busy month than an average month. So that would mean 160,000 of nominal capacity in your account. Well, at a 5-to-1 CFD leverage at IB, that's only 32,000 of margin. We then go on and add another 25% headroom, which for us is for any time a trade goes offside, you're going to need to cover more margin. Plus, even though you've upped it to 16 trades, there might be a really active month where it goes to 20 trades, and even then this would cover it. So we make that sort of a comfortable figure for carrying this group of Fast 50 at 5-to-1 CFD margin. So we'd allocate 40,000 of margin to it. The average net profit after the margin interest paid was about 71,626, and that imputed 179% annual return, equating to about 8.9% per month. So that's fantastic. This is all based on Yahoo Finance historic adjusted close data. And please remember and see our disclaimer, this is information and educational purposes only, and it's based on a hypothetical trading account. This is back testing. So one last thing we want to highlight is please, if you want to protect yourself from big losses that might occur, do not trade raw signals. Always check the news to filter out signals deriving from fundamental value shifting events, and avoid earnings releases and dividend dates within the forward trade window when you're looking at a trade signal. Really important. If you want to learn more about how to do all of that, sign up to our webinar, sign up to a free trial of PTF Pro, and we have a 3-hour pair trading video course taught by a professional pair trader that will take you through how to trade every one of these signals that come out of PairTrade Finder Pro. And as we are, what are we on? We're on 31st of March when we're doing this right now. Let's just see what's happened with this top 50. Since the 19th of March when they went live, there's been 3 entry signals and 3 exit signals. And on those 3 exit signals, you have 3 profitable trades, 220, 170, 201, making $591.65. So nice. First 3 exits have been positive. And let's see how this develops over the next little while. Forced to show you guys this disclaimer and notice. Please read that and understand. And happy trading, everyone. We hope you sign up, take advantage of all the educational materials we've created, and learn to pair trade stocks, co-integrated stocks, and consistently profitably. Thank you very much for your time.